Welcome to Biz Wire. I'm Joseph Nordstrom in Beijing. Reuters reports that China's Shuanghui, which has agreed to buy U.S. pork producer Smithfield Foods for $4.7 billion, plans to list the combined company in Hong Kong after completing what has become a controversial takeover. Sources say a Hong Kong IPO valued at around $4 billion would allow the merged group to trade in a market that would place a higher valuation on the stock than the U.S. or other exchanges. Hong Kong is a much bigger and more international stock market than Shenzhen and would also offer an ideal exit route for Shuanghui's private equity investors, which includes Goldman Sachs and New Horizons. The Smithfield deal has yet to close, the sources cautioned, and plans on what happens after the takeover would only be finalized after the completion of the deal. Virginia-based Smithfield is the world's biggest hog producer and a major exporter to China. Smithfield was under pressure from its top shareholder to break up the company when it announced on May 30th the Shuanghui takeover offer. U.S. politicians immediately expressed concern about a Chinese company buying a Virginia food producer, though Shuanghui has promised to keep the Smithfield operation intact. The deal, the largest ever by a Chinese company into the United States, would allow Shuanghui to directly sell American-raised pork products across China to meet the country's huge demand for the product. Should Shuanghui complete the transaction, Smithfield would be delisted from the New York Stock Exchange. People familiar with the matter said the combined Smithfield-Shuanghui operation is being valued at around $20 billion, meaning an IPO of around 20% of the group would be worth around $4 billion. Shuanghui's acquisition of Smithfield, which has more than 46,000 employees in 25 states and 4 countries, faces a few more steps before it becomes final, including the need to smooth over political concerns that it would hurt U.S. food safety and raise prices for American consumers. Smithfield President and CEO Larry Pope last week faced questions from U.S. senators concerned about the long-term impact of the deal and told them that the firm was not going to change. Some senators want the Committee for Investment in the United States to block the deal under its authority to stop foreign investments that it deems threats to national security. They claim the sale of the corporate farm to a Chinese company could pose a threat to America's critical infrastructure and give China agricultural technology. This is a serious issue, and at stake is the largest ever Chinese investment in an American corporation and the future of China's perception that it has fair access to the U.S. market. The senators' actions threaten to undo a lot of goodwill and substantive progress between the U.S. and China regarding bilateral investment because there is no plausible national security issue in the deal. Just last week, China and the U.S. announced that discussions would move forward toward a comprehensive investment treaty between the two countries that would have the potential to vastly expand bilateral investment and, along with it, trade. Unfortunately, some politicians want to undo what could turn out to be a very lucrative deal for many Americans just for a soundbite in prime time. You're watching Biz Wire on the Blue Ocean Network. Stay tuned for more in Economic Insight.